Hello, fellow Robo Capitals. Hope you're well. I am back with my good buddy Jeff Snyder, and we're going to talk about some plumbing stuff here that could be a little concerning. So, first and foremost, Jeff, thanks for coming back to the show, buddy.
Always my pleasure.
So, what I'm referring to specifically, Jeff, is I was just seeing online that the broker dealer banks are loading up on treasuries and I believe mortgage backed securities. And what's rather alarming is I think it's the highest level since Q1 of 2008, if this report is correct. And it's very similar to what they did during 2023 when we had the regional banks, a lot of them blow up with Silicon Valley Bank. So my first thought was, wow, okay, maybe they're loading up on collateral because this is what's going to be, or they believe, they're making a bet that things are going to get worse and therefore they're going to be able to charge a higher price for that collateral and make some profit. But I wanted to get you on to get your thoughts on this and kind of give me your view as to what's going on.
Yeah, I mean, that's part of it. It could just be balance sheet de-risking too, where you just add more treasuries as just balance sheet ballast, for lack of a better term. That's the problem with all this economic or the banking statistics. We don't know exactly why. We can see what, and we can make those comparisons. We don't actually know why. Yeah. So it could be one of those two things, but either way, it doesn't add up to anything that's positive.
Right. So let's assume for a moment that, is that correct that I stated that they have the highest amount of treasuries they've had since Q1 of 2008? Was that correct?
That's what the report said. I mean, for the specific set of dealers that we're talking about. Yeah. Again, we're operating in the Eurodollar context. We have to remember that there's a whole lot of opacity and a lot of stuff that we don't see. Right. So what we're looking at is data that is a subset of the entire whole. And we don't get to see the entire whole, nor do we really know how much the one relates to the other. So essentially what we're hoping is that when we have statistics like this, it's a reasonable proxy of what might be happening across the entire system. And that's not always a good good assumption. It might be that some parts of the system are just selling their treasuries to dealers and they're just buying them because that's what they do as dealers. But we think that because we can correlate these behaviors and these changes in behaviors to other market prices and market events, that within some reasonable degree of error, that when we see this type of thing happening, it does correspond to those types of behaviors, those types of perceptions. That when dealers are holding more treasuries, either number one, they're just buying treasuries just to hold them on their balance sheet, something safe and liquid that can give them a dependable return, where we don't have to worry about credit risk. Or in the realm of collateral, they're holding it because either they think they're going to need it for their own operations, or as dealers, they'll be able to take advantage of everyone else who out there will be short of collateral, and therefore they can charge higher prices to rent that collateral out. And usually it's both. It's one of both.
Yeah. So the bottom line there, just for the viewers, so they're following what you're saying, is you've got two options here, or two of the most likely options, which is either they're looking to expand their balance sheet and they don't see any other opportunity out there to take risk, and therefore they're going to take the least risk they possibly can by buying treasuries. That in and of itself isn't great, because if the economy was booming, or even if they saw they had an appetite for risk outside of the real economy and the financial economy, they would much prefer to take that, because that would give them a higher spread on their liabilities and assets. So the simple fact that they're doing that tells you it might not be a crisis, but they're definitely risk off mode. And then, or it could be that they're super risk off, in the sense that they see something coming that, who knows, might be similar to 2008, and they're loading up their balance sheet because they know that if that does happen, then they're going to make a lot more on those treasuries than just the 4% interest rate that they're being paid. Is that a fair summary?
Yeah, and that's another option too. It's not necessarily a riskless bet, or we're buying treasuries because they're safe. It could be a directional bet too. They could be saying, right, okay, whether or not we're risk averse, it doesn't matter. What we see is that the economic circumstances, the financial circumstances too, are less than ideal, and therefore we're going to buy treasuries, because as these fears that we have about the economic circumstances become realized, everybody will pile into treasuries. So we want to get there first, because we're making a bet on treasury prices going up, right, regardless of interest rates. So,
okay, so there could be capital appreciation as well.
Yeah, any way you slice it, it comes back to the same thing, which is we're taking advantage of something that leads to treasury prices going up, therefore the demand of safety or the demand of safe collateral going up. And
It-
those tend not to be good outcomes.
yeah, Jeff, I know you know the data a lot better than I do. Did it go into specifics as far as where they're buying in the curve? Is it
No, I
all
never.
front
That's
end?
the thing. We never get that level of granularity. Even
Right.
where some of the statistics, like the primary dealer survey that comes out every week,
Uh-huh.
they break it down by maturity bucket, and I always look at it and kind of chuckle because it's like, okay, is it really? Even if the report of the numbers that get reported, whether it be weekly, quarterly, or monthly, whether those are accurate on that day is up for question, but. Okay, so the report on at the quarter end and say this is what our data is. That doesn't necessarily mean that's what they're actually doing during any quarter.
Right.
Window dressing is a huge problem that we have too. Maybe not so much on a weekly basis with like the primary dealer survey, but it's one of those things where we have the information that we have and we just have to look at it in the proper context.
Yeah. So as far as, do you think this would play into that repo spike we had the other day, just on the Fed's balance sheet? And then didn't we have, I don't know, maybe 2 weeks ago, where the 4-week bill was going quite a bit below reverse repo? Can you explain?
Yeah, there's a couple of different things there. The 4-week treasury bill, the yield just kind of plummeted. Really, it just felt like the bottom fell out from it, which is
Yeah.
unusual, obviously, because you should never see it go below the reverse repo, even in situations like there are some debt ceiling mechanics that go along into it because money market funds are avoiding certain bills right now because the debt ceiling still isn't resolved, and there's not necessarily a hard limit, but there's a potential for a problem to develop in the middle of August. So we've seen the 3-month bill rate go up. We've seen
Okay.
the 4-week bill or the 8-week bill rate go up, which is money market funds avoiding those specific bills.
Okay. Then
And
they
as
can flow
as
into
they're
the 4-week. All right.
yeah, so if they're not buying 8-week bills, they're buying 4-week bills as a replacement. But okay, you buy a 4-week bill as a replacement, but you're not going to just accept any return on the 4-week bill because you're still profit seeking. So if the 4-week bill the 4-week bill yield goes below alternatives, then money market funds are not just going to own 4-week bills just for the hell of it. They would shift into repo. At its
Or reverse
worst,
repo.
for them it would be repo. From the Fed's perspective, it's reverse repo.
Right.
But they would shift into something higher yielding. They wouldn't own the treasury bill at something well below even the reverse repo rate. So the fact that the 4-week bill was down as low as it was, especially that final auction, which was a Thursday, they always auction the 4 and 8 weeks on Thursdays. It was a Thursday, I forget what day. It was June 26th, I believe it was. The high yield at the auction was 4%, and you're like, okay, what the hell's going on here? And
What's
then of
reverse
course
repo right now?
that was the yield on the bill. The reverse
No,
repo is
I
four
know,
and a
I know,
quarter.
but what is it?
Reverse repo is 4.25.
Okay, so let me explain that for the viewers real quick. So what you could do if you have cash is you could just give that cash to the Fed in their reverse repo facility, and you could get 4.25%, 4.25% on your money. But what's happening is we had this auction where there were all of these funds with money market funds or whatever, these financial institutions with cash, and instead of giving them to the Fed giving that cash to the Fed risk free 4.25%, they chose to buy the 4-week bill at 4%. So they're taking 25 basis points less than they could by just simply parking that money at the Fed. So that in and of itself is a head scratcher. You have to say, well, why on earth would anyone do that? That doesn't make any sense. And the answer could tie into what we're seeing with the broker dealers, that they want those 4-week bills or they want treasuries in general, because if the stuff hits the fan, then they can rehypothecate those treasuries. They can lend those out and make much more than that 25 basis point haircut that they're having to take by buying the bill to begin with.
Yeah, so if you're getting 4%, and it's a little bit higher than that when the investment yield, but either way, you get 4% on the 4-week treasury bill, even though you could get 4.30 in repo. What you're betting is that if collateral becomes scarce enough, you can get a 40, 50 basis point spread on lending out the treasury bill, and therefore you've covered up the opportunity cost. I think that's what gets confusing too, is we're talking about two separate groups. Just to be clear, we're not the money market funds that are avoiding the 8-week bill because of debt ceiling are not the ones who are buying the 4-week bill down at 4% to take advantage of collateral. There's different groups of people
So
in the market.
those would be the broker dealers, the ones
Those
that
are the dealers. They're the ones who are saying we can take advantage of collateral because we can rent it out to increasingly desperate participants in the market who are short collateral for whatever reason.
Okay, so then does this tie into the big repo spike that we saw on the Fed's balance sheet the other day, or was that just quarter end?
I think that was mostly quarter end, but we're talking about quarter end, and that's why a lot of these things arise near quarter end, because that's where, as we said before, the window dressing is at its maximum. And window dressing is not just writing down numbers on a balance sheet and then publishing it at the SEC. Dealers actually do have to change their behavior. They have to pull back in their dealer activities at quarter end to meet these window dressing desires, to show their balance sheets as less risky than they actually are. So there is liquidity pockets or illiquidity pockets in the marketplace during these quarter end periods that are very real and have very real impacts in the marketplace. So even though we're talking about quarter end and window dressing, that does leave the system relatively limited in as far as its spare capacity. So it might have been that the regular quarter end activity that we see is related to not just the regular quarter end window dressing, but something over and above that, because there is a lack of liquidity at that part of the calendar anyway.
Yeah, that's where I go back to Q1 of 2008 and the fact that we've exceeded those levels. I mean, we've had a lot of end of quarters since 2008, right? Quite a few of them. And the fact that we haven't got up to that level in the past end of quarters, again, it's not a huge red flag, but it's definitely something that I think people should be paying attention to.
Yeah, it's all. Anytime we get these signals, it's not like, hey, this is the only. I mean, this is the one warning you need to pay. It's not the bat signal going up here. It's just okay. This is something that we need to pay attention to. And if it gets to something like this, where you have comparisons that are this dramatic, what that tells you is, okay, this is something I need to pay attention to today. And so I need to do a little bit of homework and see what else is going on that might suggest the same type of thing. Because like I said before, it might just be some kind of technicality that we're not aware of, that we can't see because the rest of the system is that opaque. So if this thing is flashing a warning and this thing over here is flashing a warning, and this other thing is flashing a warning, then you start to take it more seriously. But this is where the information processing starts. When you look at all these indications and say, okay, this is something that's unusual. What does this actually mean? We need to do a little bit more homework.
Okay, so talking about unusual stuff, what's going on with the long end of the curve in Japan?
The Bank of Japan. That's all about the Bank of Japan.
Okay.
The Bank of Japan has essentially created an environment where the biggest holders of JGBs don't want to hold JGBs until the Bank of Japan stops being irrational. So the Japanese central bank is raising rates because it believes that the Japanese economy is under an inflationary experiencing a true inflationary problem as they understand inflation, which is tight labor markets, expectations theory. They also have the yen problem, which is the weaker yen leads to higher import costs, which filter in through to consumer prices. But either way, the Bank of Japan says we still have an inflation problem. Therefore, short-term interest rates are going to be increasingly uncertain. That's the term they always use. And so the long end of the yield curve under these conditions tends to be more volatile and move more. So if you're a large holder of long-term JGBs and the Bank of Japan is saying, we don't know when we're going to stop raising rates, what are you going to do? Well, I'm going to sell my JGBs today and I'll buy them back when the Bank of Japan finally gets to where it is it's going to go. Or market circumstances force the Bank of Japan to come back to reality and say, okay, you're not going to go any higher. So what has happened at the long end of the JGB curve is all the pension funds and insurance companies in Japan have gotten out of the market. I think it was Mizuho that said, very publicly said, we did this. Bank of Japan made us do this. We cut our JGB exposure by 2/3. 2/3. One of the biggest holders of JGB said, we're going to sell our JGBs today. And then they said this, we're going to buy them back once the Bank of Japan is finally done with whatever it's going to do. So as I've been telling people more recently, the biggest source of uncertainty in the marketplace is central banks when they're supposed to be the opposite. So JGB yields, the Bank of Japan has essentially undercut all of its biggest buyers, and they're just sitting on the sidelines waiting for all of this to finally work itself out.
How do you reconcile that with the long end of the curve always being about growth and inflation?
Because it is about growth and inflation with the, that's why they're going to buy them back at cheaper prices. It's growth and inflation expectations that are in treasury yields or JGB yields or, German bond yields. Growth and inflation expectations are always there, but they're not always the primary consideration. That's why you have short run fluctuations in any market. Otherwise, market rates would just go to a single level and stay there. There's always back and forth. So right now with the longer run holders of JGB, longer run JGB holders are saying is, we believe growth and inflation expectations are for long end Japanese rates to be much lower. However, we recognize that in the short run, or maybe even the intermediate term, this degree of uncertainty that's being created by central bank policy means that whatever we believe of long run fundamentals and growth and inflation, over the short run, the volatility makes it difficult to own these instruments.
Yeah, I think as investors, what we have to realize is there's like 1,000 different cross currents that are impacting interest rates at all times. So you can't just focus on one thing, even if it's growth and inflation expectations, because although that may be the overriding factor over the long run, over the short term, you can have influences at the front of the curve by the Fed or the Bank of Japan. It definitely can influence things, but then you have to zoom out and say, okay, over the next 3 years, what's likely to be that overriding factor again? And that's going to be growth and inflation expectations, but it can be a wild ride in the interim because of all these other variables.
Yeah, just look at market interest rates here in the United States, treasury rates since the bond rally began back in October 2023. We've had these big moves down, then pretty big moves up, and then big move down, and big move up, and back and forth. And what makes it challenging, and you know this very well, George, is that every time rates go back up, everybody comes back with, it's inflation again, it's the debt fears, it's any number of the Sell America theme. So you do have to. I mean, while you can't totally ignore these short run fluctuations and variations, you do have to step back and say, is this a short run variation, or is this something fundamentally different? And that's why you never focus on one thing or another. You look at the treasury yield curve or the JGB curve and find as much information as you can about, okay, is this a difference as far as fundamental perceptions and projections in the marketplace, or is this some other factor temporarily taking over the top spot for market participants?
Yeah. So what's interesting there is the one thing that you don't see really impact yields in the United States or Japan is supply.
Yeah, I know.
but I think there's an argument that you have seen supply impact yields in the UK or expectations for supply. How do you see the what do they call it when Liz Truss came up, the blow up they had there?
The gilt crisis.
The gilt crisis. Yeah. How do you see that? Is that a supply issue, or is that something else?
I think what we're seeing here at the UK is that it's not, just like 2022, it was not a supply issue. If it was a supply issue, why did it disappear? Because the supply situation didn't really change ever since then. 2022, the UK government didn't all of a sudden discover fiscal sanity. That never happened. What happened was we had a global circumstance in 2022, which led to volatility in long-term interest rates, but made holding UK gilts among the worst pieces of collateral. But it's not just the UK. It's not just U.S. Treasuries. People are talking about the U.S. Treasury and debt supply now bothering the marketplace. Well, that's because long-term interest rates are rising in the U.S., in Japan, in UK, in Germany, and all of these places. It's globally synchronized. And the long-term rates are rising, not because everybody is suddenly afraid of the U.S. government, the German government, the UK government, the Japanese government suddenly becoming irresponsible. They've been irresponsible the entire time. That much hasn't changed. So that's not the explanation for why global long end interest rates are rising, and global long end interest rates are rising right now relative to where they were a couple of weeks ago. They're not rising overall. The reason they seem to be rising is because we have curve steepening going on, and curve steepening it gets applied to all of these different bond markets around the world. That has nothing to do with these individual national priorities and national circumstances. So it's not necessarily a UK gilt crisis, but if your perception and your understanding of the UK market is the boundaries of the United Kingdom, you're looking for answers for why long-term UK rates are rising, and you don't know that they're rising in other places around the world because the global curve is steepening. You think, well, this has to be the bond market is rejecting the UK government's budgets because the UK government budgets are absolutely insane. But then you have to step back and think, well, UK government budgets have been insane for many, many, many years. That actually isn't changing. So why would the UK market suddenly discover the UK insanity and say, oh, today now it matters where it didn't matter just a couple of weeks ago?
Okay. So, well, I think the argument there, Jeff, would be that they came out with that budget, and so you can mark a specific point in time when that budget was released, then yields skyrocket. So how was that not a catalyst? I think, wouldn't you say that that was a contributing factor, but that wasn't the main reason? That might have been the straw that broke the camel's back.
Well, see, again, I think that language is too strong. It's not the straw that broke the camel's back. What it did is remember, markets are not monolithic either. In every marketplace, even where rates are going down, you have people who believe that there's too much debt and they're willing to trade on it. And there's always speculators who are saying, I'm going to do what, whatever the market is in the short run. So you have all of these competing opinions going on in the marketplace. And in any short run period, one of those opinions can rise to the surface where, okay, there isn't exactly the same amount of urgency that would force those who are long bonds to buy more bonds. In fact, they actually like the fact that this narrative has developed that governments are going bankrupt, because what that means is there's going to be lots of short sellers out there who are selling bonds that are going to be forced to cover and do so desperately at some point in the future. So I'm going to sit out the market, let rates rise and prices fall, and then I'll buy again when the prices hit the whatever level I really think of. So you have all these competing interests in the marketplace, which is why you see these short run fluctuations. So the idea that UK rates are skyrocketing, or that they're soaring, or that something substantial or significant or fundamental has changed here, I don't find that argument compelling. I think what's happening is, in the short run period that we find ourselves in right this moment, rates tend to be rising, and people are filling in their own narratives about why that is. And in the marketplace, because there isn't something immediate and urgent today that compels the other side of the marketplace, the bulls in the marketplace, to buy, they're just sitting there waiting for prices to be cheapened, like the pension funds and insurance companies in Japan, waiting for the right moment to start buying all over again.
Why don't we typically see those bumps with headlines in the United States? So as an example, the big beautiful bill comes out, that gets passed. So now all of a sudden we know that that's going to increase the deficits by X amount. That's going to increase the debt by X amount. Why don't we see a gilt-like moment where, even if it's just a knee-jerk reaction for 2 or 3 days, that yields spike and then come right back down? Like I can't remember a time when I've seen that happen in the treasury market. Now, I have seen it happen in the treasury market where Trump comes out and says, okay, no more tariffs, as an example. And then you might get a bump in yields because the market is expecting that growth is going to be higher. Or we get not a blowout, but we get a better than expected non-farm payroll. And then you see yields go up slightly because it's expecting that the Fed's going to stay higher for longer, or growth and inflation is going to be better than we otherwise thought. So I see those types of headlines moving treasury yields, but I never, ever, ever see the supply side, even like a knee-jerk reaction like we saw in the gilt market. Why do you think there's that substantial difference between the gilt market and the treasury market?
Well, the treasury market is far more internationalized to begin with. It's covered. Its primary purpose is way beyond just the United States, whereas the UK is more of a niche. It does have a little bit more of a local flavor to it, whereas the U.S. Treasury market is far more internationalized. But I would say, George, that we do see that. There are times when, even on the short run basis, where, for example, if you remember back, when was that? November of 2023, the horrific 30-year bond auction. Now, that wasn't specifically related to government announcement, but it was related to the narrative that supply was getting to be too big. So you had this 30-year bond auction that's, and the idea was that the 30-year was where this bond vigilantism was going to start. And so here we are in November of 2023. Rates had only started to go down again. So it looked kind of like a fluctuation. The narrative was that the government had gone way too far. Plus, they had destroyed the dollar and all of the negative things: inflation, higher interest rates. So you had a 30-year bond auction come out, and it was relatively poor, but poor is too strong a term, but relatively poor compared to other bond auctions. And there was a pretty substantial reaction to it in the short run. It lasted maybe a couple of days. I'm going off the top of my head, but it was a day or two where rates, moved up, and then the rest of the fundamentals got priced right back in. The bond rally kept going and was all forgotten about. So you do see it, but you don't see it on any more than a really short run basis. You go back to 2011. There was another 30-year bond auction in the middle of the crisis in 2011 that did the same thing. I think you had a 20 or 25 basis point move in the 30-year bond, which is enormous. Huh. And that was after
2011.
Yeah, that was right after S&P downgraded the US government debt for the first
Right,
time.
right.
So everybody was already on edge about this stuff. And then you had a 30-year bond auction that was horrific, and rates rose, and then he went right back down again because the banking crisis that was going on at the time completely overwhelmed any idea that government debt was going to matter. So you do see in a short run basis, it's not as prominent in treasuries because treasuries are a much larger marketplace that are focused less intensely on domestic considerations.
Okay, that makes sense. What do you think the probabilities are the Fed cuts in July? I mean, that's coming up in a couple weeks here.
That I hate to give you conditional probabilities, but it is conditional on what happens tomorrow.
Or what's okay? Explain that further, Jeff. And while you're doing that, I'm going to go ahead and pull up what the Fed Watch is. The Fed Watch right now, just for viewers, just FYI, we got 16 days, and it's a 95% that the Fed stays where they are.
Yeah, I think if the CPI tomorrow comes in less than expected, and I think the expectation for the core CPI is about 0.3% on the month. If it's still like a 0.1%, I think they cut in July. And I think they do that because we've seen a number of concerning economic data points, especially in the labor market. I've been pointing out average weekly earnings. Average weekly earnings is one of the most important ones because first of all, it's nominal terms, but also it's nominal paychecks among regular workers. So we're talking about in production and non-supervisory workers, which is the vast majority. And on a 3-month basis, they've been negative for one of the only times in the last 30 years. So that tells you that paychecks have been unusually weak because hours have been unusually weak. Hiring has been unusually weak recently. And as we know, the Fed has an institutional bias toward inflation, but they're usually shaken out of that institutional bias when they see more concerning accounts in labor.
Is that metric something they pay attention to?
Yes, that's when they pay attention to. They don't pay as much attention to the household survey, but they do, and they realize that the unemployment rate fell for all the worst possible reasons. We had 750,000 Americans drop out of the labor force in the last 2 months. So they're paying attention to the weakness in the labor statistics. And consumer spending, that's a big one. Personal consumption expenditures are down on a real basis for the first 5 months of the year, which is another one of those things that we rarely ever see. So it doesn't necessarily mean that we're into a recession, but it's weak enough and unusually weak that they are definitely paying attention to it. So if they get a benign CPI report that allows policymakers led by Christopher Waller and Michelle Bowman, who are two of the most influential people on the FOMC, they'll say, look, you guys keep saying that you're afraid of inflation. That's all theoretical. We don't see it happening. We don't see it in this would have been the 4 straight CPI. If what happens tomorrow happens and it comes in benign, that's 4 straight CPIs where tariffs have been implemented and they are not filtering through to consumer prices. We've got all this stuff over here in the labor market. I think we need to avoid doing what we did last summer, which is appearing to be behind the curve and then having to feel like we have to catch up with a 50 basis point rate cut in September. So if you get a benign CPI tomorrow, I think they cut at the end of the month.
Okay. That's interesting. Yeah, we'll have to.
It's interesting because nobody else believes
that. Yeah, but I mean 95%. But tomorrow's a big day. It's a big day, so we'll have to pay attention to that for sure. What do you think about the most recent move in the dollar? I think, and when I mean most recent, I'm talking about the last month. I think we've gone from 101 down to, we were trading at a 96 handle or so. My theory is it's all about interest rate differentials, and that as the data softens in the United States, the market expects the Fed to get a little bit closer to the ECB. And that's in the short term, just impacting the dollar. I know in the long term, that doesn't really impact the dollar, but I think that may explain the move over the last month. What do you think?
Yeah, with the euro is more interest rate sensitive than other currency exchange crosses. So yes, the US dollar to euro does have an interest rate differential component that's much larger. And I absolutely agree with you, George, because the ECB is way out in front. They're down to 2% already. European rates are already lower to begin with structurally, but they've gotten a little bit out of a line, out of historical relationships. So right now there's a favoritism. There's higher rates in U.S. treasuries relative to German government bond yields. And if you believe that short-term rates are going to go down again, just by nominal levels, the Federal Reserve has farther to go lower than the ECB does. So in the future, the marketplace is saying, okay, if U.S. treasuries are going to go down, rates are going to go down in the future by a lot more than ECB or European rates, then start transferring funds now. I do think, though, there's something else going on with the euro too, and that there is an institutional bias in terms of speculation and trading. This Sell America thing, I do think that has been taken as an institutional thesis, and not necessarily by institutions themselves, but institutions who are serving their customers who are bought into this idea. And so the idea is that, hey, if there's a Sell America component that we can actually take advantage of, it's likely the euro. And so there's been a huge amount of selling over and above what you would expect from just interest rate differentials. Because if you look at differentials, even future differentials alone, it's not enough to explain the degree of decline in the US dollar relative to the euro. I think it has to do with overhyping Sell America and using the euro as the sort of investment vehicle for that thesis. So the euro has gotten way out of whack with almost every other exchange value, which has caused quite a bit of problems in other exchange crosses. And I think a lot of it has to do with short run speculation. And if that's the case, then with the fundamentals, with especially Europe being weaker, it risks reversing pretty substantially when it actually does happen. But the dollar is not overall, the dollar is not weakening, it's not falling, it's not crashing. It just looks to be, when you look at DXY, when it's was down like 96.80 or whatever the low was. I mean, that's a 3-year low. So okay, that looks like the dollar is incredibly weak, but against almost every other currency, including not just emerging market, but other developed countries' currencies. I mean, Canada, the Canadian dollar went way down, and now it's come back since the worst case tariff was taken off the table, and the Canadian dollar is basically where it was when all of this started. So basically, retrace the extreme levels from the last couple of months. That's a very different narrative than the U.S. dollar is crashing.
Yeah. So I think the reason people say that's just the rate at which we've seen the decline. And when you look at, I think the last time we saw this level of decline, and focusing on the DXY, you have to go back to like 1973. So I think that's why the narrative.
George, even that's cherry picked. They're saying that the rate of change over the first 5 months of the year. So you only have, 32 comparisons to make. It's not, and then nobody said anything about the speed of the rise on the way up. It's cherry picking data to fit a narrative. So yeah, DXY is weaker because there's a lot of reasons why the euro is has shifted. And by the way, the euro does this. This is not unique. This is not unusual. Look at 2008. Look at the exchange value of the dollar to the euro during 2008. It was way up and way down and way up and way down. And it kept that way for several years throughout the 2011 banking crisis too, way up and way down. And what happened to the euro over time? The euro went down, not the dollar. So I think what happens in a lot of these situations, as we talked about with interest rates, in the short run, when the dollar is doing this or the long run treasury is doing that, you hear, okay, this is inflation. This is the dollar doom. This is the dollar doom coming. So that's when you got to step back and look at, okay, if that was the case, what else would we see? Would we see dealers loading up on U.S. treasuries if they thought the treasury market was about to blow up because of debt supply? I mean, dealers are not infallible by any means. I'm not making that case, but they have a lot more inside information than we do. And at the very least, that argues so consistently and emphatically against that idea, you at least have to stop and pause and say, okay, these two things, the narrative here doesn't line up with what we're seeing in actual evidence here. And this is pretty compelling. So we need to take at least a second look at it.
Yeah. Another thing I'd say too about them considering changing the SLR is, and I don't really think that would matter because I think banks will get around the regulation, whatever regulation it is. But the simple fact that they're considering changing it, why are they?
It's actually going to be changed.
Load up on treasuries. Well, if everyone's dumping treasuries, well, why would they need to change the SLR?
Well, the idea, I think what the argument they're making is that it's specifically targeted to avoid something like what happened in April with the basis trade. So the idea is that, okay, if hedge funds are forced to sell, and of course we don't pay attention to why hedge funds are forced to sell, because God forbid we talk about the dollar shortage that forces them to sell. But if we have hedge funds that are forced to sell because they're leveraged to their eyeballs, if we lower the SLR commitment from dealer banks, which they did do, by the way, that's it only has to go through the final processes there. But
yeah,
what they're arguing is if they give dealers more balance sheet capacity, less of an SLR capital charge based on owning treasuries, then they'll step in and buy treasuries that hedge funds are selling that they couldn't step in and buy when we went through the basis trade blow up in 2000 or in April. We also saw the same thing in March of 2020. And it's it's putting together a narrative based on incomplete facts and incomplete truth.
Yeah. So giving them the benefit of the doubt on this one, we'll say that the motive, the stated motive behind changing the SLR is more giving the banks the opportunity to provide that liquidity as an arbitrage play, as opposed to wanting to buy those treasuries because they think growth and inflation expectations are coming down and they want to profit from that.
Yeah. So, I mean, it's all basically the same thing anyway.
Yeah. Where can people find out more about what you do, Jeff?
Sure. Anywhere. Eurodollar University YouTube channel. We post videos there every day, almost every day, 6 days a week. And Eurodollar.university subscriptions there. We go into the Eurodollar mechanics, swap spreads, all of that good stuff.
All right, buddy. Thanks for coming on such short notice.
Oh, my pleasure, George. Thanks.